program is brought to you in association with First National Bank of Botswana.
FNB, how can we help you?
A short while ago, you were probably shocked when you realized the debit on your monthly installment on some, if not all of your loans was higher than usual. Wondering why? You probably called your bank to report an anomaly on your account, to which your relationship manager responded with a serious affirmation that it was all perfectly in order. It was probably then that you learned of the new monetary policy and revision of the monetary policy rate as introduced by the Bank of Botswana. This means a slight increase on how much it would cost you as a customer to borrow from a bank. However, one may wonder, why now when the economy is still struggling, especially since there has been an immense rise on the cost of living? Economist at the First National Bank of Botswana, explains firstly what a monetary policy is and why the revision of the monetary policy rate.
Just to start us off with what monetary policy is, it's basically a tool, or rather a framework that's used by the central bank in order to try and meet certain objectives. And one of the key objectives is controlling inflation. And to do that, we have what we now call the monetary policy rate, which was effected in April. And prior to that, we had what we call the bank rate. And the switch was basically necessitated to try and improve not only the signaling of the central bank's stance in terms of trying to control medium-term inflation expectations, but also to improve transmission to the broader market to try and meet some of its objectives, especially in line with inflation.
This change comes about when headline inflation hit double digits earlier in the year in January and then in April. So what correlation can we derive from the way inflation has been behaving and the new monetary policy rate?
So in terms of the correlation, I think it's best to always start a step before. So in terms of what we had before, in terms of the bank rate, I think there were certain structural issues that were determined or identified in terms of its ability to be able to try and control inflation. So the bank rate as it stood was the rate at which commercial banks could borrow on an unsecured basis from the central bank. And the issue is that the Botswana market is long liquidity. So there was never really an instance, or there were very few instances where commercial banks actually accessed that rate with the central bank in order to borrow funds. So any changes in that rate were not really transmitting into the market. So what we've switched to now is called the monetary policy rate, which was essentially the 7-day BOPC yield, right? So the BOPC, the Bank of Botswana certificate, is a tool used by the central bank in order to mop up or inject liquidity into the market. So by adjusting that rate, they're able to then control the level of liquidity in the market, which should then translate to funds available for funding, as well as contribute to control inflation.
Reducing the lending rate has been shown to not have an influence in Botswana borrowing more. So what now of a lending rate that has been hiked, coupled with the rising cost of living when we're looking at how much food parcels cost now, fuel and utilities?
That's precisely the reason why we had to switch to the new rate. So it was because that transmission in terms of affecting the level of credit locally wasn't really being experienced. And the switch to the new rate is expected to be more effective because it directly controls the level of liquidity in the market. And the response that we're seeing now in terms of the hiking cycle is done to try and control inflation expectations. So we've seen inflation rising, as you rightly mentioned, but it's been more from the supply side. So it's not necessarily any increase in demand from you and me going to the shops. The hiking is necessary to try and control inflation expectations over the medium term and prevent any situations where inflation is now being driven by the demand side and kept elevated as second round effects start to kick in. And also the hiking is also necessitated by the fact that we also need to keep in line with what especially our major trading partners are doing. And that's to try and curb the possibility of any capital outflows, especially in a situation where we're only now really starting to build up our FX reserves following the pandemic disruption.
While cautious steps were taken to introduce the monetary policy and revise the monetary policy rate, Would this decision not have perhaps insatiable impact on the country's incomplete economic recovery since the pandemic? I mean, we're looking at the timing of it. Is it not ill-timed?
I think the timing is a difficult one to determine with all certainty. So it obviously followed a process of engagement between the regulator as well as commercial banks, as well as other development funding institutions and other partners to try and determine how to try and improve Botswana's monetary policy framework. And I think the timing of the changes that we've seen followed the conclusion of those discussions and the determination of which rate we should switch to. So in terms of it being ill-timed, I think when you have an instrument that you deem not to be appropriate in trying to drive the kind of behavior you expect from the market, it's imperative that you implement any changes that are necessary as soon as possible. So I like to think that the timing, as we've seen it happen, followed that entire process and was instituted at an appropriate time, considering that reforms were needed to try and improve Botswana's monetary policy framework.
What would it take to have the rate revised down? Is it something that's possible anyway?
It's something that's possible, and what it would take to have it come back down would be inflation also taken back down to within the central bank's 3 to 6% objective range. And currently as it stands, even from the central bank's forecasts, inflation is expected to remain elevated at least until the third quarter of next year. So it's more and more likely now that the direction we're taking is up because of these pressures that we're seeing, and trying to anchor inflation expectations going forward to ensure that inflation does in fact tick back to within the objective range.
Honorable, thank you once again for coming on First Issue. So maybe before we let you part, wrap up our conversation with, briefly explaining what all of this means for, the ordinary Motswana Gogae, for you and I.
Any changes that we see in the rate as it is basically reflect the rate at which we can borrow from commercial banks. So any increases would reflect increases in the rate at which we borrow from commercial banks. So even if we have existing floating facilities with commercial banks, the expectation is that when we see a 50 basis point increase, our installments should also increase by a similar amount. And any opposite directional change that we see would also affect the rate at which we pay back some of our existing facilities with commercial banks.